So I'm really honored to kick the Deutsche Goldmesse off with an important topic today. We are talking about navigating the commodity cycle. A little introduction. My name is David Giesecke. I'm the founder of Cycle Investment Strategy, and I'm actually a fully qualified lawyer here in Germany. But to be honest, that's just a hedge in case I go bust in the commodity space. So my real passion is about the financial markets, and that's why I'm here today. A little introduction about Cycle Investment Strategy. It's a research firm focused on commodity research and market cycles, converting it into two products, one ETF strategy for a more long-term oriented cycle approach, and more shorter-term approach with the main product, the Cycle Investment Strategy Report. So let's start with a more top-down approach here. Let's talk about the cycles that are the most important, the big asset cycles. So many of you know that the markets are moving in cycles. Probably the most important one is the one between the emerging markets and the US markets or the developed markets. As you can see here, we have seen tremendous outperformance of the US markets versus the emerging markets during the last 14, 15 years. And it's been abysmal for emerging markets. We are now at similar levels seen at the 2000 dot-com bubble lows or highs in regards to the US market. So from a cycle perspective, we should soon see a change that benefits more the emerging markets or the rest of the world instead of the US market. And what is interesting is when you lay over the commodity cycle over this emerging market cycle, you can see that this is tracking each other pretty good. So we have here the Goldman Sachs Commodity Index versus the S&P 500 and overlaid over the emerging market cycle. And you can see that we are in similar movements here. So the last top for commodities versus equities was in 2008 with this blow-off top in oil. The emerging markets reached their bubble high in 2010. So I think both are aligned. This is also fundamentally driven because the dollar gets weakened in phases when the emerging markets get inflows and outflows out of the US, which benefits the emerging markets because their debt is financed in US dollar. And also a lot of emerging markets are commodity exporters, so their economies benefit from rising commodity prices. So every time we have seen those cycle changes where we've seen a commodity or an emerging market cycle. We have seen at least a lost decade for the US market. So generalist investors will have to pay attention to the commodity space and to the emerging market space if they don't want to lose their purchasing power or their real get a real return on their investments. So these are the biggest cycles I think many of you are familiar with. What you can do also is break things down a bit into smaller pieces. So we are seeing here the sub-cycles between gold and the commodity space. Here the Goldman Sachs Commodity Index, which is heavily allocated in oil and energy. And you can see this flip-flopping of gold leading the pack, the commodity pack, and yes, commodities are following that with a time lag. And this is due to oil is tracking direct inflation or is producing inflation itself, and gold is tracking inflation expectations and therefore being the leader of the commodity space. So you can see this here. Crude oil is tracking inflation. Here's the US 10-year yield as a proxy for inflation because the US 10-year yield rises and falls with inflation rising and falling because investors seek a higher yield when their purchasing power is diminishing. And you can see it in gold that is inverting or has an inverse relationship to this US 10-year yield. And this is also the reason why gold is not really performing well in phases where we see actual inflation. Except hyperinflation, then gold performs also well. But in a normal inflationary environment, gold is more front-running the inflation itself. So what is very interesting is this flip-flopping correlation between oil and gold is following similar patterns. The crude oil to gold ratio can be follows an 11-year cycle. As you can see here, that follows this pattern on the right, where we first see an outperformance of the oil and general commodity space before we see a mid-cycle correction and at least one other outperformance phase for oil and other commodities before we are heading back into a cycle low. And this is a pattern that has occurred all the time since 1980. So what have we seen now? We are at a phase where we've seen the first oil and general commodity outperformance out of the COVID crash lows. And we are now at an interesting point. We're now at this mid-cycle correction point, and we should expect at least one other outperformance leg up for oil and other commodities before we are heading into another low for oil versus gold. So this is where we are right now. We are at the point of this mid-cycle correction where gold has once again outperformed and other commodities are lagging. And this chart shows the underperformance of several commodities. We've seen the underperformance of the Goldman Sachs Commodity Index. We're now near the COVID lows. Copper has also severely underperformed gold, and wheat is even worse. And what is also a very important development that is happening right now is the breakdown of the Dow to gold ratio. We've seen this breakdown because of the recent market fear in this tariff war situation, where money was flowing out of riskier parts of the market, or in general out of the market into the safe haven asset gold. And this has occurred also during the COVID crash, when money was fleeing out of stocks into gold, and to some degree also in 2016, and the most important one in 2008. So what is happening after this breakdown? Money has flown out of the stock market into gold. It's actually the most exciting time that is following the breakdown. After the Dow gold ratio breakdown, we're seeing that the riskier parts of the precious metal sector get the real inflows. So here you can see the ARSA Gold Bucks Index, which is made up by a lot of gold producing companies. And you can see in the black line the Dow to gold ratio. And when you look at the 2008 phase on the left, the big purple box, you can see what happened after we saw this breakdown. In the 2008 crash, we saw the most spectacular outperformance of the riskier parts of the gold and silver space. Silver rallied to $50 in a spectacular run. Mining companies did really, really well. And it's this phase where the Dow to gold ratio consolidates after the breakdown. We also saw it in 2016 to some extent in a shorter form. The Dow to gold ratio broke down, consolidated, and we saw equity flows going into the riskier parts of the sector. And also the recent one in 2020, the Dow to gold ratio broke down, consolidated, and we saw those flows in the riskier parts of the cycle. This is, I think, the biggest question here today. When is the riskier parts of this sector finally getting inflows? And it's exactly after those risk-off events, after money has already shifted into gold, and now we're waiting that the money is trickling down from gold into the riskier parts. So what is also very remarkable is the gold-silver ratio. We have once again blown out to over 100. So this is also a risk-off move in parallel with the breakdown of the Dow to gold ratio. So gold flows are attracting so much money that even silver can't keep up. And we have only seen this 3 times before in history. This data set goes back to 1693, but I would say it's the whole time of humanity that this has happened. So 3 times, one in 1940, one in 1991, and in 2020, and now. And I've put those times when we have blown out in the gold-silver ratio above 95 on the silver chart. And you can see at these little purple dots, where were we at the silver price when we had this gold-silver ratio blowout. So every time we blown out on the gold-silver ratio, silver made a significant low. What we're also in 2020. What we are seeing now is that silver is not doing that bad. Silver should have been absolutely smoked in this risk-off environment, as silver is also perceived a riskier asset. So I know a lot of you are probably a bit disappointed with your silver performance, but silver has actually never done this well in such a risk-off environment where money is flowing into safe haven assets. And what is also interesting, if we go back a few slides, you can see it also in the ARSA Gold Bucks Index. Normally, the Dow to gold ratio breakdown, which is indicating this risk-off flight to safety move, the gold mining stocks have done really well. This is also only has happened after the 08 crash or during the 08 crash. In the early phases, the ARSA Gold Bucks Index was also able to decouple from the Dow gold ratio flight to safety and show relative strength. So what we are seeing right now is we see enormous relative strength in silver, and we are seeing actually relative strength also in the miners, which should have been absolutely smoked in this risk-off move. So now we're coming to the tools you can use to track this smaller subcycles, as the subcycles only provide a view where the market should head, but it's not an exact timing tool. So one tool I like to use a lot is the commitment of traders data. For now, the most interesting commodity in regards to the commitment of traders data is probably oil. We can see here the positioning of the commercials in the crude oil future. The commercials are the ones that actually get their hands dirty in the sector, the producers, the physical merchants, so the smart money that knows how the market dynamics work. And we can see that they are now highly allocated, or in regards to their positioning band on the upper end positioned. And you can see in these green boxes that those times when they were highly allocated, those times were significant or at least intermediate lows for the crude oil futures. So this can provide further evidence that we might see outperformance of the also of the other commodities, in this case for oil. So also sentiment is obviously always helpful to have a look at. Here from Sentiment Trader, the sentiment data for crude oil, we have seen a significant pessimism in crude oil that is now turning up. Sentiment is not really also a perfect timing indicator, it's more a condition. So selling every euphoria or buy every pessimism is short-sighted because it can sustain for a while, but it's a condition where you should look for a low. So what is also a very nice tool is looking at actually the sector inflows, and I've a very nice chart here for the GDX miners. This is the Van Eck Gold Miners Index in black, and in blue we have the assets under management, so the money that is actually invested in the gold miners. So we can see that on the blue line that we are very pro-cyclical in this regard. We can see that at tops people pile their investments into the gold miners. We see a disproportionate rise in the AUM, and on the other hand, in phases where the price is in a bear market or very low, we can see a disproportionate low assets under management. And what we are seeing now is nearly unprecedented. We are seeing actually people are selling the strength in the gold miners. So you see the blue line has not kept up with the price. We are still at the AUM, not even at the highs of the end of 2024. So people are using the strength in the gold miners to finally get out of their investments. As you can see, in 2020, we had a disproportionate rise in AUM. This is probably the time where most of the investors bought the GDX and have sit on it for 4 years, 5 years, and with an abysmal return, and are now relieved that they can break even on their investment, get out. But maybe it's exactly the wrong time to get out of the sector, and maybe they should pile in now. So thank you very much for your attention, and I look forward to any questions that may arise.
Thank you very much. Question, do you believe the real estate in USA is going to crash? Because what I gathered is now, I'm a simple retailer. What I hear, etc., that for private equity they bought when the interest rate was very low since 2008, and they are sitting now on huge losses actually, and also due to Corona, real estate, commercial real estate, for example, is not in a good shape. So, and also, for example, the people in the USA, too many people in the USA, they're not doing so well, and they would also like to sell, for example, their properties. And if that would create more, would there be a connection to buying something more secure?
So I'm not a real estate expert. I follow it on the side. I have an eye on it. But my take to the US real estate sector is a bit more nuanced, I think. I think the commercial real estate already had their problem, already went through a lot of forced deleveraging. And I think the retail investors that bought their houses on low interest rates and locked in rates are pretty fine for now, because after 2008, I think a lot of people got burned, and no one in the US is on a large scale using flexible rates anymore. I think this is also you can put also a cycle theory to it. If people have learned something with pain, they likely are not going to repeat it. So it's also the risks in the market never come from the same area, because people got aware of the risk and adapted to it. So I'm not seeing a really structural risk in the complete whole real estate sector, but maybe in some parts the higher interest rate environment is forcing deleveraging. Yeah.
question. If you are comparing the Dow Jones and the gold price, don't you have a statistical bias there, as you need much more money to move the Dow Jones than to move the gold price?
So if you look at this ratio, we have a lot of market participants that are following momentum. This is maybe a trend that has only got stronger. So it's more about money flowing where momentum is occurring, and I don't think that it's particularly a problem that we need more money to move one asset class or move another asset class, because if an asset class is small, it also needs smaller inflows to move it. So this momentum-driven market, I think, this is my theory, is only making moves stronger and making shifts even more brutal and violent, because so many participants are just focusing on chasing momentum nowadays.
Thank you.
Yes, thank you very much, David, for your presentation. You showed there the silver ratio, the silver ratio. Major contributory factor to that is central banks have been buying gold around the world. They're not buying silver. They're not buying stocks either. Also, maybe the retail sector, maybe in China, people are allowed to hold gold. They can have a gold account. They can buy gold beans and put them in a jar, whatever. But they're not interested in the North American stock market. So, I mean, have you any information on? So the dynamics are in large part being driven by central bank buying. What we're really interested in is therefore more the retail side. That the retail side in the West needs to really take off. We need to see them buying into gold. Some people are selling simply because they're broke and they need the money, they need to pay off debt. Have you any comment about where we are with the retail sector? Because until that takes off, we're not really going to see, things cascading down into stocks and then into the junior stocks.
Mm-hmm. I think this is a typical dynamic that the retail sector is the last that is participating in rallies. They are always piling in at the later parts of a rally. This is also leading to this performance disproportionality that you get. I don't know the exact percent number, but you get a huge percent of your gain in the latest stage of a rally in this blow-off top phase, when the last retail investor is also piling into this sector. So this is a normal behavior that we have seen so far, that retail is reluctant to buy the strength in this sector, and it's more a positive sign, I would say, that we have not seen this so far, as we are not in a late stage environment for the whole industry. So this, when I see a lot of retail participation, I'm not getting bullish. I'm not excited about it, because this is telling me that we are at a very late stage for a sector. So that central banks are only buying gold is something we have seen forever. I'm not sure if any central bank is also holding silver as a reserve asset, but it has always trickled down to also the silver price and riskier parts of the sector. You just kind of have to trust the ever-occurring cycles of this market dynamic.
Sorry, on the central bank gold buying, has that always been a feature within the cycles, or is this different this time because of how significant and how aggressively they are buying?
The central banks were pretty. I had a chart seen about this. Central banks are pretty smart buyers for gold, actually. Not all central banks. I think the Central Bank of Canada is doing actually the worst of all. But a lot of central banks are pretty good gold buyers, and they normally buy pretty anti-cyclical. This is really a new development, that we see such a pro-cyclical action of central banks now buying into this strength even more. which gives also an indication of that we are maybe in a kind of a super cycle in this regard, that we are seeing like a real big monetary shift here, that central banks are acting this pro-cyclical and just trying to get out of US treasuries as reserve asset and piling into neutral reserve assets like gold.
On the gold-silver ratio, today it's exactly 1 to 100, 3,200 on 32. I think most in this room say it's unlikely that gold is going down significantly, hopefully. So what you see going forward is it's a very strong chart that we hit 100 and then we go down again. So is silver going up? What is your view? Or are we disregarding this chart and is it just going over the 100 for the first time?
That's a good question. This is only historical evidence. Of course, everything is possible in this environment, especially when we see such big macroeconomical and monetary changes that may come along. Maybe if we see a revaluation of gold through the US government overnight to reduce their debt problem, everything is possible. We could shoot up to, I don't know, 150, 200. But it's you have to use the historical. You only have the historical data to try to predict the future or to assess risk in the future. I'm very positive for silver because we have a lot of data points that are showing that we should see flows coming now into the riskier parts. So as myself, I'm very bullish on silver, but of course, this big disruptions we are going through, everything is in the short term possible.
Do you think would it take for the TikTok generation to get interested in gold and gold stocks?
I think it's all about performance. If you have a generation that is ready to buy Fartcoin, if it goes up, I think they also will be ready to buy gold mining stocks when they rise. We had in 2021 we had the silver squeeze movement where we saw actually market impact on the not too small asset class by just retail investors cornering up together, and this was, I think, largely driven by also younger investors. So I think they are very agnostic to just play what's going up.